If you're a business owner, listen up. There's a section of the tax code that could let you sell your company, pocket millions, and pay no federal capital gains tax.
Yeah, boy.
That's not clickbait. It's called Qualified Small Business Stock, or QSBS, and hardly anyone knows about it. QSBS isn't some loophole. Congress created it in the 1990s to encourage entrepreneurship, investment, and job creation. The idea was simple: reward people who take the risk of starting and investing in small businesses by letting them keep more of the upside when they sell. So imagine you sell your business for $20 million. Normally, you might owe $4 to $5 million in federal taxes. With QSBS, up to $15 million of that gain could be excluded completely. That's money you get to keep, money that funds your next business, secures your family future, or just gets reinvested tax-free. And if you're an investor, it gets even better. Each qualified business has its own exclusion cap. That means you can repeat this process across multiple companies. I've seen cases where owners sold businesses for $12 million, walked away tax-free at the federal level, all because their shares qualified as QSBS. So, how do you qualify? I'm glad you asked. There are lots of requirements, but there are 4 main rules. Number 1 is your company must be a C Corp. It can't be an LLC, an S Corp, etc. Number 2, whenever you receive company stock, the assets for the business must be worth less than $75 million. Number 3, industries matter. Most industries qualify, but not finance, law, accounting, or hospitality. And number 4, hold the stock for at least 5 years to unlock the full benefit. Starting in July 2025, if you sell your business earlier than 5 years, you can still keep a massive chunk of your gains tax-free. For instance, if you sell your business after 3 years, you can exclude 50% of your gain. If you wait 4 years, you can exclude 75% of your gain. And if you wait 5 years, you can get a 100% exclusion on the gains. But here's the plot twist: state taxes. QSBS is powerful at the federal level, but states make their own rules. California and Pennsylvania don't conform, what a surprise, meaning your gain can still be taxed at the state level. Some states partially conform, but with lower limits, so it may not be 15 million, it may be 5 million. And other states like New York, Georgia, Florida, Texas, either conform fully or they have no state income tax, making QSBS a true home run. Now, here's where QSBS gets really exciting: stacking. The exclusion limit is $15 million per taxpayer per company, but you don't have to keep all the stock in your name. If you gift QSBS shares to your spouse, kids, or trusts before you sell, each of those taxpayers gets their own $15 million cap. So here's what that looks like. You're about to sell your company for $50 million, 50. If all of the stock is in your name, you can only exclude $15 million and pay taxes on the remainder. But if you spread out that ownership, maybe $15 million for you, 15 for your spouse, another 15 for a trust for your kids, suddenly $45 million of that sale could be excluded from federal taxes. That's not a theory. That's families with big exits have used stacking to save tens of millions of dollars in taxes. It takes careful planning because you need to transfer the shares early, follow gifting rules, and plan for gift taxes. But it's one of the most powerful wealth transfer strategies available to business owners today. So here's the bottom line. QSBS can be the difference between selling for $15 million and writing a 7-figure check to the IRS, or selling for $15 million and keeping nearly all of it. If you're building a business today or investing in one, you owe it to yourself to understand QSBS, because one smart decision now can echo for generations, turning a business exit into lasting wealth.